Hey team, it's Nathan Watt here from Watson and Watt. Today's video, I'm going to run through a pretty common question I get about the difference in profit and cash flow. So, the usual story is the business has made a profit, but where's the cash? And this is particularly amplified in a growing business or a new business as well. So, I thought I'd just run through some basic numbers to show you how the cash can significantly vary from your profit number. So, let's assume this is a new business. I'm an accountant, so I work in financial year, so July through to June. Starts off with $10,000 of sales, 20,000, 30,000, and keeps growing up. Over the course of that 12 months, we get to $1 million worth of sales. They've been able to manage their cost of goods sold to 30% of their sales over that period, giving a 70% gross profit for each month. Their wages start off at 5,000, and then they start to kick up into 30% of sales each month. Overheads remain the same at 10,000 until January, when they realise they're running out of space and they're growing so fast. I need to take on some more space and all that sort of stuff, so they double their overheads in January, giving 180,000 of overheads for the year, leaving a net profit of $190,000, which is 19% of sales. So a pretty good return for a new business, and that excludes any taxes so far. The tax payable on that will be $52,000 in the following financial year. So $190,000 profit. What does it look like for cash flow? This is based on some assumptions. So this is 30-day invoice credit. So you invoice a customer today, they pay you in 30 days' time. So that means that in July, all the invoice they raised in July, they get paid in August. Now, not only do they get paid the $10,000, they actually get paid $11,000 being GST inclusive. So in June, they had to spend some money to get some stock to sell in July and August, and pay some people to help them get that stock on the shelves and all that sort of stuff. So some expenses there in June of $14,900. Haven't received any money. July, we made $10,000 of sales, but we don't receive any cash until August. So again, we've had to buy more stock for September and pay some wages. Also got to pay June super and pay the overheads, including GST. So in July, we made a loss for accounting purposes of $8,475. But for cash flow, we've actually spent $26,375. So that sucks. In August, $20,000 of sales, have a net loss there of $1,475. In August, we received the cash from September sales, so $10,000 of sales, $1,000 of GST. We pay for the stock, we pay for wages, we pay for the overheads, and now we've got to pay June's BAS, or lodge June's BAS, and that's a refund of $900 being the stock amount that you purchased back in June. So net cash for August is minus $17,300. As you can see, so September they start to make a profit, a small profit there, but they're still negative in cash flow. And that's because they're always buying stock in advance. So they're buying stock 2 months in advance, and they're getting paid 30 days after they invoice it. So if you look at August, we invoiced $20,000 of sales. We're getting paid in September. But in August, we're buying stock for October. So there's a fairly different cash flow model there, because in October, we're not getting paid for that stock that you're buying back in August until November. So you've got about 90 days between when you're paying for things and when you're actually getting the cash. So in a growing business, this just gets amplified each and every month because you need to buy more stock and put on more staff and more overhead. So over the course of the year, $190,000 net accounting profit, but we've still got minus $155,000 of cash. Now, this doesn't include any balance sheet items either, as in didn't buy any plant and equipment or didn't pay down any debt. So this is just GST and overheads and things like that. So that's a fairly significant difference between accounting and cash. So what if you say, well, okay, Nathan, I don't give my customers 30 days credit. They pay when they buy the goods. So I've run this little model here as well. So in July, we invoiced it. So same stock components. In July, we had $10,000 of sales, all that sort of stuff, still negative $8,475. But in this model, we receive payment when we sell the goods, but we're still $15,000 in the red. And this continues for a few months until sales start to catch up. So again, $190,000 net profit for accounting purposes, cash flow is positive for the whole year of $85,000. So we're still $105,000 difference without paying our income tax, which won't be due until the May the following year. So yes, you've made a profit, but you're still short on the cash. So what can we do about that? Well, at the moment, there's 2 months of stock in advance. What if we can get that stock down and get cash on delivery, cash on sale? So we're buying less stock. We're getting the cash when we make the sale. You can see the cash model here is a lot different to the previous one. So $190,000 accounting profit. We've got $157,000 of net cash. So you've got enough there to pay the tax man in a few months and pay yourselves as well. So these things can make massive differences to your business. So it's very important to understand the implications of the credit terms you give to your customers. So what's the difference between 7 days or 14 days? Well, it could be a lot. What's the difference between 30 days from invoice or 30 days from end of month, or any of those things really impacts your business quite significantly in terms of cash flow, particularly when you're growing quickly. So it's really important that you model these decisions in your business. So that's all today. Just a quick video to run through the differences that can apply between accounting and cash purposes. If you've got any questions, just give me a shout. Cheers.